You've seen him on ETF Battles. He's one of our highly esteemed judges. He's also the founder and CIO at Astoria Portfolio Advisors, which is based in New York. John Davi, it's great to see you. Glad to have you with us.
Great to be back with you on ETF Battles, Ron.
Yes, but today's not going to be a battle because we're just going to scrape your brain a little bit. And I want to begin by talking about the sharp rise that we've seen in stock valuations since the March coronavirus crash. But even so, you say that the federal funds rate, with it anchored at 0%, there's still room for stock valuations to expand. Talk about that.
Sure. So I think, one of the first things I learned when I worked on Wall Street in the late 90s was this idea of like the dividend discount model. So when you lower interest rates, it makes the future value of your cash flows higher. So I do think that multiples have expanded pretty rapidly because, the Fed has kept interest rates low and they provided a lot of liquidity into the system. The irony, Ron, is that, yes, we're on the high end of the S&P forward PE ratio. But once you get past the S&P 500, there are so many sectors and themes and other market cap ranges that are much lower in terms of PE ratio. So, we are firm believers in active management of factor-based ETFs. We tilt away from the market cap. There's EES, which is a small cap ETF from Wisdom Tree. It's got a 12 PE ratio, okay? And this compares to the S&P, which is in the low 20s. The Wisdom Tree midcap ETF, EZM, another ETF from Wisdom Tree where they don't just use market cap weighted as a criteria. That has a 13 PE ratio. Sectors like energy, have a much lower PE ratio than the S&P. So I think it's just, really just large cap index that's gotten to be expensive. Once you gravitate towards other sectors or countries outside the U.S., you find the PE ratios to be much more, much lower and much easier. But no doubt the Fed keeping interest rates lower have caused multiples to expand. I think that's okay. The Fed has not told you that they're going to raise interest rates anytime soon. So yes, be cautious, look to rotate, but I don't think it's like a sell signal per se for the time being. I think stocks are much more attractive compared to bonds.
Let's talk about ETFs linked to small and mid-cap stocks, and you alluded to this. These types of stocks have underperformed relative to their larger cap peers, not just in 2020, but over the past 1, 3, and 5 years. And now with the coronavirus hitting smaller businesses the hardest, it seems to me like mid and small cap stocks just can't catch a break. How do you see it?
It's funny. The Fed in 2018 was taking liquidity out of the system. So if you remember, we had the Christmas Eve massacre when the S&P fell 4-5% just on that one day. In that one quarter period, the S&P fell 25%. Now we're at a point now between, the Fed and other central banks globally, they've expanded their balance sheets. I think it's like $4 or $5 trillion. So I think now, you've got a margin of safety. You've got a floor to financial assets. With small caps and mid caps trading below large caps, I think it makes sense to own small and mid cap stocks. Plus, what you find is that macroeconomic indicators, PMIs, they've troughed and their rate of change is starting to inflect, noticeably higher. And that's when you want to own small mid-cap stocks, which are more cyclically oriented. Their earnings are more, tied to the U.S. economy. There's a chart that, we'll put up on the screen here that shows during March, April, May, small and mid-cap earnings were significantly derated much more than large caps. That makes sense, right? Because large caps are more defensive, they're higher quality. Small and mid are much more lower quality. So I think, what you see now, there's a trough in earnings across all market cap ranges. And I just think now you've got this margin of safety with mid and small. So we like that. We've increased our small cap exposure in our portfolio this year. Small caps are one of these factors that are persistent, pervasive, robust. It's cheap to implement. It's another great factor to own in your portfolio.
Excellent. So let's move on to talking about one of your favorite asset classes. This is according to your third quarter update. is bonds. So which area of the bond market do you like?
There's not a lot of, we purchased corporate bonds because we thought that they, on a relative basis, were more attractive compared to, let's say, muni bonds. A lot of states, I think they're going to run into some big deficits. You've got the Fed that's buying corporate bonds. They've bought a lot in the open marketplace. I wouldn't say we like bonds more than stocks. We still much more prefer stocks compared to bonds, but I think on a relative basis, we prefer corporates. We also did add preferred equities. So PFF is a new ETF in our portfolio that we added this year. There's a 5% yield. You get equity-like returns with bond-like volatility. Banks are about 26% of that ETF. And I think, banks is an area that I'm comfortable owning. These have become like regulated entities. They've got stronger balance sheets compared to 2008 when we went through the crisis. The government has kind of mandated with their stress tests. So I'm comfortable owning banks in general, and PFF is a nice way to play the banks with its 26% ownership. So between corporate bonds and preferred, those are two areas that we added to our portfolio this year.
And you're in good company, by the way, with banks, because Warren Buffett's been adding more exposure to Bank of America. He's been a fan of financial stocks for a long time. So again, you're in good company there. One last thing, John, before you take off, your firm offers advisors and RIAs an easy solution for professionally built investment portfolios, specifically ETF portfolios. So why are advisors opting for outsourced portfolios versus self-built portfolios?
So good question. To get to the heart of that, I think it's, more of an financial advisor at the end of the day, they've got to do tax, estate planning, maybe annuities, insurance. They've got to do behavioral coaching. I don't think their job necessarily is to manage a portfolio, deal with tax loss harvesting, rotating the portfolio, monitoring it. I spent 2 decades working, doing research on trading floors at Morgan Stanley Merrill Lynch, when all I did was build portfolios and solutions for institutional clients. So I'm taking those skill sets and that knowledge that I've had and that I've garnered over 2 decades working at the institutional level, and I'm applying those principles, for advisors. And I just think that, at the end of the day, what our firm does, we do research analysis, we build portfolios. They range from cross-asset ETF portfolios. We have quantitative single stock portfolios. We do option overriding. We've got retirement analysis where we help advisors determine the probability that their end client's going to achieve their retirement goals. We've got dashboards that we've built out that look at factor risk, country risk, performance attribution for our models, the advisors' models. So for a reasonable price, I think we're able to give advisors institutional caliber research and tools that they can apply so that they can be better at what they truly do, which is the behavioral, the insurance, annuity, estate planning, and all the other things that they do, in their portfolio.
Well, that's some good insight and very timely insight. And thank you so much, John, for taking the time to drop by. Keep up the good work. We'll see you on the next episode of ETF Battles. I'm Ron DeLegge. Thank you for watching ETF Guide TV. We'll catch up with you next time.